Welcome to the Deep Dive, where we cut through the noise to give you the essential insights on what's really driving the global economy right now.
Yeah, and today we're tackling three really significant shifts. They all happened pretty recently, late 2025. And honestly, they prove one thing. Volatility isn't just happening sometimes, it's the new normal in global economics and trade.
We've got some pretty detailed analyses here, stuff covering, trade deals breaking down spectacularly, some surprising wins in manufacturing, and this big reorganization of global commerce, kind of away from the usual players.
Exactly. So our goal today is to make these three kind of complicated stories really clear for you. We're talking first, a major trade deal that just went sideways fast. Second, advanced manufacturing, specifically chips, actually succeeding big time here in the U.S.
Which nobody expected.
Right. And third, this rise of what we're calling South-South trade developing nations becoming their own economic powerhouse.
Okay, let's unpack this, and we'll start with a real shocker. A deal involving a key U.S. partner that turned into a huge $350 billion problem almost overnight. So earlier this year, there was this agreement shaping up. Looked pretty straightforward.
Seems sensible, yeah.
The basics were the U.S. cuts tariffs, about 15%, mainly on cars from this partner country, and in return, they promised $350 billion in investment in the U.S.
And the partners saw this as, a long-term thing, a fund for loans, investment guarantees, equity stakes spread out over years.
Manageable, something both sides could work with, or so it seemed.
But here's where it gets really interesting. September 25th, the White House puts out this statement, and the key change was one word. The $350 billion had to be paid up front.
Up front. Not invested over time.
No, not a fund,
Beautiful.
just cash now. Basically demanding the whole amount immediately.
Okay, let's make that real for a second. It's like you agree to buy a house, right? You get a 30-year mortgage all signed, and then the bank calls the next day and says, hey, you know that whole loan amount. We need it in cash today.
Yeah, that's pretty much the level of absurdity we're talking about. It's just not how these things work.
And for the partner country.
Yeah.
I mean, what does that demand actually mean for their finances?
Well, the impact is immediate and, frankly, terrifying for them. Our sources picked up their official government response, paying $350 billion in one go. That's 83% of their entire foreign exchange reserves. They only have about $410 billion total.
83%.
Yeah. Their president said publicly that paying it would risk a foreign exchange crisis, like a full-blown meltdown of their currency.
That is absolutely crippling. How could they possibly agree to that? They need some kind of guarantee.
Right, a safety net.
They can't agree.
Not like that. Which is why their counter-demand tells you everything about how scared they are. They immediately said, okay, before we even talk about upfront payment, we need an unlimited currency swap with the U.S.
Okay, hold on. For listeners who might not know, can you quickly break down what a currency swap is and why it's the ultimate safety net here?
Sure. Basically, a currency swap is an agreement between two central banks, the Fed here in the U.S., and the central bank of the partner country. They agree to exchange their currencies, maybe at a fixed rate, sometimes for an unlimited period.
Okay.
So if the partner country did pay out that $350 billion, their own currency's value would probably tank, right? Triggering the crisis they fear. The swap acts like a giant emergency credit line. It guarantees them access to U.S. dollars if their currency crashes, which helps stabilize their whole financial system. It's basically insurance against the very crisis the U.S. demand could create.
So the pressure isn't just about getting the money. It's about forcing them into a position where they need this massive U.S. backstop. It's about leverage.
Seems that way. And the pressure keeps ramping up. The administration pointed to Japan's promise of $550 billion in investment, kind of suggesting the partner needs to increase their $350 billion commitment, as if the upfront demand wasn't enough. But maybe the most, let's say, aggressive move is this other threat.
This is the new tariff threat, the one that overrides the earlier deal.
Exactly. A potential 100% tariff on pharmaceuticals coming from any company in that country that doesn't build factories here in the U.S.
100%. That's basically a ban.
Pretty much. And remember, the 15% tariff reduction on cars never actually happened because the July deal wasn't finalized. So cars still face a 25% tariff.
So you've got cars and pharma, two huge export sectors essentially being held hostage in these negotiations over the upfront cash.
That's the term used, yeah. Hostages. It's become a really high-stakes game of chicken.
So is this really about getting $350 billion cash right now? Or is this maybe, I don't know, an impossible demand? A tactic to force a complete reset of the trade relationship on U.S. terms?
Well, looking at the pattern of this administration, it feels more like the second one, doesn't it? The goal might not be the cash itself, but using the threat of economic chaos to get maximum concessions.
Maximum leverage.
Right. And the deadline seems to be the APEC summit in October. That's when the leaders meet. Everyone expects that to be the breaking point, one way or another.
Okay, so the big takeaway here for anyone investing or just trying to understand global business.
It's that volatility is baked in now. You absolutely have to factor in a high political risk premium. Any deal, any investment can be turned upside down by a single statement, a single headline. Market swings based on policy announcements are just part of the game now.
Okay, so if that's the unpredictable side of U.S. policy, let's flip to where policy seems to have forced a massive and surprisingly positive shift. Let's talk about the U.S. semiconductor factory turnaround, because this really is a complete U-turn, right? For years, everyone said building these advanced chip plants, like for TSMC and Samsung, here in the States was a bad idea.
Oh, yeah. The consensus was money pits, liabilities, construction costs too high, labor costs too high compared to Asia. Doomed to fail, basically.
But the recent data just blows that away.
Completely. Take TSMC in Arizona. Analysts were genuinely stunned when that plant reported its first ever half-year profit, $150 million in the first half of 2025.
A profit already, that's fast.
It wiped out 4 years of losses in just 6 months. Incredible efficiency.
But the stat that really jumped out at me from the source material was about the chip yield. You know, the percentage of good chips they make.
Ah, yes. You mean the fact that the Arizona plant's yield is actually 4% higher than their main factories back in Taiwan?
Exactly. 4% higher. That just demolishes the whole argument about U.S. manufacturing being inherently less efficient for this stuff.
It really does. That was the mic drop moment, you know?
So why? How are they doing it? Is it just better robots, better automation? Or is there some labor advantage nobody saw coming?
It's overwhelmingly automation and just really dialed-in processes. In these super advanced factories, labor costs are actually a tiny fraction of the total cost, like under 2%.
Under 2%. So the fears about high U.S. wages were overblown for this industry.
For the operational cost, yes. The analysis shows the total cost to process a silicon wafer there is maybe only 10% higher than Taiwan, and that difference. It gets easily covered by subsidies from the THPS Act, and this is key, customers willing to pay a bit more.
Right, and we see Samsung having similar success down in Texas. Their big worry used to be finding enough big customers, right?
That worry is gone. Mid-2025, Samsung locked in huge deals, one with Apple for the image sensor in the next iPhone, the iPhone 18.
Wow, Apple.
And an even bigger one with Tesla, an 8-year contract worth something like $16.5 billion for their next-gen self-driving chip, the AI6.
These aren't small deals. These are cornerstone clients.
Yeah.
So why are Apple and Tesla choosing the slightly pricier U.S.-made chip instead of just importing from Asia like they used to?
It comes down to what we're calling the Made in USA premium. It's not just patriotism, it's smart business now.
How so?
Well, first, it fits the whole America First political climate. Using U.S.-made chips helps insulate companies like Apple and Tesla from potential regulations or trade fights down the line.
Ah, de-risking their supply chain politically.
Exactly. And second, it just makes their supply chains more resilient, less vulnerable to, geopolitical shocks, shipping problems, all that stuff.
So the calculation totally changed. Making chips in the U.S. isn't just a cost anymore, it's actually a strategic advantage. It attracts the best customers because it offers security.
That's it, precisely. The slightly higher wafer cost is easily worth the strategic benefit of having that domestic supply locked down.
Which means these companies operating here deserve a higher valuation.
You could argue that, yeah. The operational risk, like can they actually make the chips profitably, seems largely solved thanks to automation. The main risk now, it shifts back to political uncertainty. Well, will the government use the IPS Act funding to demand equity stakes? Will a future administration change the rules, the subsidies, the regulations? The success is now tied directly to Washington's next move.
It's ironic, isn't it? Government policy helps create this huge success, but now that success is kind of dependent on ongoing political stability. Okay, let's zoom out again. We've seen unpredictable U.S. trade policy and surprisingly successful U.S. high-tech manufacturing. The third big shift is happening more broadly across the globe, this rise of South-South trade.
Yeah, this is a really profound reorganization. What's happening is that emerging markets are trading more and more with each other instead of primarily exporting to the US and Europe.
They're building their own ecosystem.
Exactly. It's creating new centers of economic gravity. Our sources talk about a new G3, China, India, and the ASEAN nations. They're becoming major producers and major consumers, all interconnected.
Make that concrete. The sources use the car market in South Africa as a key example, calling it a fierce battleground.
Right. Historically, you'd see mostly Western or Japanese cars there. But look now. Indian brands like Mahindra and Tata, plus several Chinese automakers, they now have over 25% of the passenger car market combined.
A quarter of the market already. Why are they winning?
They're hitting the sweet spot for the growing middle class there. Decent quality, but at a really aggressive price point. Plus, and this is crucial, they're investing locally.
How so?
Tata and Mahindra are rolling out affordable electric vehicles specifically for that market, and they're building out service centers, distribution networks. They're embedding themselves locally.
They're not just shipping cars in, they're building a presence.
Precisely. And interestingly, Western companies aren't just giving up, they're adapting. Ford, for example, is actually increasing its investment in its South African supply chain.
Really? Why?
To meet strict European and UK emissions standards, they're turning their South African plants into specialized hubs to export vehicles back to Europe.
Clever. And Mercedes-Benz is doing something similar.
Yeah, they're shifting their South African production entirely to high-end, high-margin luxury models, mostly for export. It's like they're saying, okay, we can't compete with India and China on volume price, so we'll focus on specialized, high-value exports from here.
It's adaptation, finding a new niche instead of retreating.
Exactly. And this whole localization theme plays out huge in e-commerce, too. Look at Jumia. People call it the Amazon of Africa.
Right, I've heard of them. They were struggling for a while.
They were. But after a big restructuring, they hit a major milestone in the second quarter of 2025, their first ever quarter with positive operating cash flow.
Wow. How did they pull off that turnaround?
A big part of it was this China direct strategy. They started sourcing goods directly from Chinese manufacturers, cutting out middlemen.
Why Chinese manufacturers specifically?
Because those manufacturers are also looking for new markets, right?
Yeah,
Especially with trade tensions making the U.S. and Europe less certain. So Jumia offered them direct access to African consumers. It slashed costs and boosted Jumia's margins.
Okay, but now the giants are noticing Africa. Temu, that huge Chinese online retailer, just entered Nigeria and Kenya in September. That sounds like a huge threat to Jumia.
You'd think so, right? But Jumia has what the analysts call a localization moat.
A moat, meaning?
Meaning Temu is finding Africa isn't like the U.S. or Europe. They're struggling with really complex customs rules in different countries. They're struggling with the fact that many people prefer to pay with cash, not credit cards or digital wallets.
Ah, cash on delivery is still big there.
Huge. And then there's the last mile logistics. Getting packages to people's actual homes or pickup points can be a nightmare if you don't know the local areas. Jumia has spent years building that specific infrastructure, figuring out cash payments, mapping delivery routes.
So Temu might have the money and the scale, but Jumia has the crucial on-the-ground knowledge and networks.
That's a moat. It's a huge advantage. And the lesson for anyone looking to invest in these emerging markets is really clear.
What is it?
Localization wins. You need to back companies that are building real local infrastructure, payment systems, logistics networks, maybe even local production, not just companies trying to export into the region. Build locally or struggle.
And underlying all this South-South trade growth,
Yeah.
It's not just about selling raw materials anymore, is it?
No, not at all. It's driven by the massive, rapidly growing middle class in these regions. They want affordable consumer goods, cars, electronics, clothes. They are the new engine of demand, and that's why the global trade map is fundamentally redrawing itself.
Okay, let's wrap this up. 3 huge shifts we've covered. Let's recap the key takeaways for you, the listener.
First, global deals aren't set in stone. That $350 billion upfront demand shows how quickly things can change. Volatility is just the reality now. Political risk is paramount.
Second, made in USA for strategic goods like chips. It's not a burden anymore. It's a premium feature that attracts top customers like Apple and Tesla, thanks to surprising efficiency gains and political necessity.
And third, global trade's center of gravity is shifting away from the traditional West towards this new G3 of China, India, and ASEAN, driven by their own consumers and protected by deep localization.
And if you connect the dots, What's the common theme here?
It's the undeniable link between geopolitics and business. You simply cannot separate corporate strategy from national policy, trade disputes, and supply chain security anymore. They're totally intertwined.
Which leaves us with one final thought to chew on. We saw how government policy, like the COQPS Act, successfully spurred this amazing turnaround in U.S. semiconductor manufacturing.
A huge intervention, yeah.
So should you, as an investor or just an observer, start thinking about what comes next? After chips, after batteries. What's the next strategic industry where the U.S. government might step in heavily to force localization, creating another made-in-USA premium? Where does Washington point its industrial policy fire hose next?
Finding the answer to that question, that could define the next decade of investment in American industry.
Absolutely. Well, that's all the time we have for this deep dive. Thanks for joining us as we navigate these shifting economic tides. We'll catch you next time.